Welcome to the another episode of the Real Estate Vibe Show. I'm your host, Winky Lomba, and today I have a very dear friend with me. Her name is Sandhya Seshadri. She's an experienced multifamily investor based in Dallas-Fort Worth area. Sandhya's engineering and corporate background combined with her MBA fits well into the multifamily business for working on underwriting, acquisitions, and asset management. Welcome, Sandhya. So good to see you here.
So glad to be here. We've spoken so many times over social media and had so many different interactions. It's great that you started a podcast, and thank you for having me here as your guest.
Of course. So let's start with my favorite question. How do you see yourself at the present moment, professionally and personally? Where are you?
I see myself as making a lot of strides in my business compared to where I started. If you asked me 3 years ago how far I would get in 3 years, I have definitely surprised myself. And it's a lot of thanks and gratitude to mentors and experienced people in this business, formal and informal, who've helped me along the way or given me the right advice at the right time. So I'm very grateful for that. And on the personal life, I mean, it's solid and stable just the way it needs to be. And I could probably improve a little bit on my health side. Health would be probably the biggest area for improvement.
That's true. You said it well. Health is the wealth, right? That's the prominent thing in our lives that we, often ignore because worrying about other things. So share with me a little bit about your background and how did you get into real estate from your corporate background?
Like many of us Asian geeks, I have a background in electrical engineering, and I worked for a high-tech firm doing hardware, software design, and failure analysis, product engineering kind of roles with Texas Instruments, predominantly in the Dallas area in the semiconductor industry. But I also got myself a part-time MBA because the company was willing to sponsor me for that. And so I went to evening and weekends and studied an MBA because I felt like I was missing that business knowledge and business acumen. So with that, I got into the stock market, and I went full time into the stock market from the corporate world when I had children. And I was always interested in real estate. I always wanted to have rental properties, but I did not have the handy person background to really be able to assess repairs. And I didn't want to deal directly with tenants. So the whole tenants, toilets, trash, and termites, I wanted to avoid it. So when a friend told me about multifamily and I attended a weekend event, it finally made sense. It's like asset management is something I can do with my strong, background in math and, project management kind of things. And it was interesting. It was exciting in the sense I was living in Dallas. I still live in Dallas now for over 31 years. And it's the market where all this was happening. So it's a perfect location for me to see properties and see all these improvements, et cetera, come to life. And the story started with passive investing first, seeing all the things business plan actually get executed and come to life. And I was like, oh, this actually works and makes sense. So I found partners with more experience who I joined in my first deal because I didn't want to make mistakes when it involves other people's money, taking, hard-earned money of people. Like my first starting salary was like $36,000. So imagine what was left of that after a year's worth of work, and to sort of squirrel away a little at a time to add up to $50,000. So I'm really respectful of other people's money in that sense. So I wanted to team up with sponsors who had experience because you don't know what you don't know, right? All of us start with the best intentions. We're going to do our best. We're going to give it our best shot. We're going to go work hard, et cetera. Yeah, everybody's going to do that. But on top of that, you don't know what to anticipate. And therefore, the eyes of an experienced sponsor come into play for your first deal. And that's how my first deal was, with two very experienced sponsors who lived out of state. And so I was their local boots on the ground. I was the brawn while they were the brain executing the strategy. So I would show up, I'd meet with vendors, and slowly my knowledge kept increasing from that experience. And it was a phenomenal success, which is what you want your first deal to be. You don't want it to be like oh my gosh, I lost my investors' money or I barely returned their capital to them kind of story. So that was a great launch pad. So after that, I had the raving fans that we all want to create. And so now it's been easier. So my first deal, I think I struggled and maybe raised barely $500,000. And now this deal, that we just had under contract and we raised, like, we're fully funded in 36 hours, right? And that doesn't happen unless You show a track record and you're slow and steady about it, and you partner with the right people to complement your skills, right? So maybe that was a long answer, but that's where I am right now.
Oh, that's good. So let me go back to your corporate experience. So you said when you were in the corporate, you were on the design side, hardware, software, because you're a techie, right? Just like any other Indian.
Yep, totally.
We own that skill set, right? So coming to US and starting on the technical side all the time. So
Yes.
when you move into stock market, that's the second thing, after being technical, that's most of us, we do that, right? Stock market is our gig. And how did you feel that real estate is different than stock market? Or what kind of intrigued your interest into real estate more than stock market?
For me, the first thing was the tax advantages and to really have a hard real asset because 90% of all millionaires, I feel like, became really rich through real estate. Like my parents, even back in India, I mean, they earned a great salary for India, but their true wealth was built because of properties they owned and the rental income. So even here, I felt like I wanted to have a piece of real estate. I just wasn't comfortable with the landlord issues of it. So I went for the tax advantages and for growing my wealth with a real hard asset as a means to diversify from just the pure risk of the stock market. Because, one day the stock market plummets. Let's take a date in 2008, right? Or March of 2020. There was that one magical day when COVID hit us and suddenly the stock market plunged that one day. What if that was the time that you needed to withdraw money because your kid was going to college or that was your year to retire, right? The timing matters. So I wanted to have something else that would still produce an income for me in a passive sort of way and didn't catch, the drift of the stock market up or down and let that influence how our, wealth was going to be created. Because timing is everything, right? In the stock market. So
yeah, you're so right. And it's so unpredictable too, because some people on the top sitting with the bigger bucks driving the market. So you just like, by the time it gets to you, it's kind of too late, as far I understand, because I was in the stock market too long time with my corporate job. That's how I kind of resonate with you. So it's just like, your heartbeat is going up and down all day long if you're watching that, because it's not the information just coming right to you. It travels through so many channels, before it gets to you. By the time you make a decision, it might be too late.
So here's what's to remember, right? You don't get to have any control over that. Exactly. Like when, some war happening out in Ukraine can influence your stocks. A supply chain issue can affect it. A tsunami can affect, in one particular place, like let's say Taiwan, where a lot of manufacturing happens, can completely affect your supply chain and therefore your stock performance. And it's definitely a bit of a gamble, no matter how much you study a stock or even a sector, right? You are dependent on the whims of Wall Street. And another joke is Wall Street nowadays is actually coming now to buy up a bunch of single family homes and stuff in the form of REITs. So it's like, okay, you need a real hard asset, and as much decentralized and how much of a control you can have yourself is the ideal scenario. And that's where apartments come in. That's where any form of real estate comes in.
Yeah, you said it very well. Plus, it's like a tangible thing you can feel and touch kind of thing. Not necessarily you're buying the asset, even though you're buying a share in an asset class, but still there is like somebody you can pick up the phone and get your questions answered, like kind of first-hand interaction versus just like, oh, I put the money in Apple or Google or whatever. I do not know what's going to happen tomorrow. So you started your first deal as a passive investor. I would like to hear that experience. If you can share that experience, what was it like? Was there any hesitation? You felt like you're taking any risk? Or what was your mindset at that point?
I knew that to learn the business, I had to invest in another deal without taking other people's money first. Like I had to experience it myself, do a test run, if you will, before I decided that I could go run a property. I was not hesitant about it because I had taken much of my retirement money from the corporate world and put it into a self-directed IRA and eventually into a solo 401k. So that money is something I could not use even if I was going to syndicate my own deal. So it made the perfect vehicle for me to try it out. And I invested, $50K across multiple different syndicators who were all local to the Dallas area and from whom I could learn something. So the first time that they were going to go to their property, I met them there. I saw what they were doing with the property. I was very much, all about hands-on learning because that's what I didn't have a background in. I didn't have a dad who flipped houses, so he was just, very technical in his world, and that's all that he knew about. So I never grew up learning all of that back in India. So when I come here, I'm like, I don't know anything to fix up a house. We lived in a house, and every time we had to fix something, it would be my husband learning it from some video or calling a handy person. So that's why it made sense to invest passively, because it's a great learning tool. I think of passive experience as if you want to eventually syndicate your own deal, but you want to become a better operator, this is your hands-on training. This is your internship. You don't get paid much, but then you can go there and you learn and observe and grow so that you can take that job, that full-time job, when you graduate from college kind of scenario. So it was a tremendous learning experience. Now, I've actually invested, and I still continue to invest passively in deals, but with very experienced operators who I know and trust and with whom I want to build an even stronger connection. So I've had great deals, deals do very well, and I've had, horrible deals, right? And they were completely surprising in the results, that because of how I vetted the sponsor. So I've gotten much better at doing that as well.
So I'm going to ask you a question regarding vetting the sponsors now, because you brought up a really good, point here. So how important is it to vet the sponsor, and how to pick the right sponsor that you think is going to be right for you? Did you create any kind of due diligence checklist for yourself?
Yes, I have a checklist to vet a sponsorship team that I can definitely share with your audience as well. But one of the most important thing is their actual track record. Because on social media, anyone can hype anything and say, hey, I own 10,000 doors. Okay, that's great. Can you list half a dozen of those properties? Tell me how they actually performed. And I know you're going to sugarcoat it. So refer me to a passive investor in those properties and how did they do. And, I can tell you, I was very impressed with someone who had a very strong construction background, because that's my weakness, right? I didn't grow up in construction. So I really wanted to have a strong connection with them. And so I invested passively in a very large, over 1,200 unit portfolio out in Houston on their deal for the purpose of learning from them. And that was my worst performing deal because, again, I believe the social media hype. And I concluded that construction management also means asset management. One does not include the other at all. In fact, it's two completely different things. That's so true. When COVID hit, we, in our portfolio of properties, we stopped all the CapEx projects. And what we did instead was we held on to the money because we didn't know how our delinquency was going to perform. So that was my best deal, which is the one where I'm a syndicator, and we held on to CapEx. We didn't do anything from, second quarter of 2020 till well into the fourth quarter of 2020. We saw that rents were coming, and then we're like, all right, we can release a little more funds. On the other hand, this worst performing deal by this construction person, they spent big bucks. They spent like to the tune of millions of dollars, right? When you think of 1,200 plus doors, they're spending $5, $6, $7 million over a quarter just to go on upgrading every unit, upgrade the pool, upgrade the pergola, let's replace the roof, like every possible exterior paint of that many doors. You're talking millions of dollars. And sure enough, what happened in the fall? They did a capital call. And we were like, you can't do a capital call. What is this? You should be making distributions now. You've held this property for a year. So then they changed it to a member loan so they don't dilute our shares. And so with my constant nagging a year later, they sold it, and I just got my principal back, which I'm grateful for, right? It could be worse. I could not even have gotten my money back. So I'm grateful for that. So what's the lesson learned from that? You need to actually speak to a passive investor because only they're going to tell you the whole story. If you go back and ask the syndicator, I said, oh yeah, we did great. We've acquired tens of thousands of properties. And now I'm, hobnobbing with celebrities and on the stage of every conference. Well, how's your actual performance? Do you have any repeat investors who will give you a testimonial to say, yeah, every deal I've worked on with this sponsor has had great returns. I will continue to invest with them passively. So that's very important. The other question that is a really good question, which Joe Farrell has answered recently, is how long do you know one of your passive investors? Like, who's your oldest passive investor in terms of how long they've known you? Like Vicky and I have just met in the past year and a half or so through social media, right? Compare that to somebody who's been your boss 2 decades ago, who's been in your neighborhood for 15 years, who can walk down the street and knock your door. and those kind of people repeatedly invest with you, right? That's a whole different level of trust. So the whole know, like, and trust, how many levels deep can you go on that? How far back can these people go and vouch for you, the sponsor or sponsorship team, for your character, for your integrity, for your, if any of you read, and I know I'm advertising here for Joe Fairless in this case, but when his first deal did badly, and he'll talk about it, he went back, he worked very hard to pay them back interest, not just the principal, for what he said he would achieve for them and he didn't. That's why he's got raving fans, right? So when you build that kind of trust and loyalty with people, they're going to come back to you. It's not transactional anymore. It's actually a kind of a bond. So that's one thing you want to look for, is people you can really trust. The third part is look out for people who only raise capital and are gone with the wind when the deal closes, right? So then who do you ask your questions? Who's with you when the honeymoon is over till the end of time, meaning till when the property sells, right? So that's the full cycle. So who's with you from the day the deal closes till the property is sold? You want to meet that person in the team. Who's the main primary asset manager in control of this asset till you are done with the deal as a passive investor? You want to meet that person. You want to know their track record. There's a lot of amazing capital raisers who team up with the right asset managers. And you want to find those people who repeatedly do deals with the same teams, even if their role is only to raise capital. They find good asset management teams with a strong track record and repeatedly go back to them. So definitely inquire about that, not just the person marketing the deal to you. That's very important. Beyond that, some of the basic questions you want to ask is, what is their experience in that particular market? What is their experience of the property management company in that market? How well have they done in the same type or class of property, right? Class A, B, and C is very different the way you operate them. So those are a few of the top few things I would ask about a sponsorship team for investing my hard-earned money. But I have a longer checklist I can definitely share with your listeners if they're interested.
Okay, thank you so much. So I have a few questions on this whole scenario that you shared with us. Thanks for sharing with us. So, obviously your bond with the investors has to be more than that transactional bond. I love that terminology that you use, the transactional bond, because every relationship that you're creating, it shouldn't be transactional. Like, you scratch my back, I scratch your back. What's after that?
Yeah.
Nothing, right? So we want it, our relationship should be more than that with each investor or whosoever we are meeting with.
Mm-hmm.
So in order to, create that kind of relationship, because, how would you do that? First of all, let me ask you that, if you can answer that, how can you take your relationship beyond the transactional point?
You get to know your investors, right? Do you have that kind of personal time with them? What pain point are you solving for them? How are you helping them get from where they are to whatever is that goal they have? Is it financial and freedom? Do they just love their existing jobs, but they just want their investments to grow at a faster pace without the fluctuations of the stock market? What is their end goal? In 5 years, I want to pay for my kids' college and I need this money to grow to this number, right? So you make sure you're honest with them whether or not a passive investment with you is going to get them there. Some people want to 10x their money in 5 years. Like, you're not going to do that unless you're a lead sponsor doing much of the work. And even then, I don't think, like in my deals, I'm not getting a 10x return. I may get a 4x or 5x return, provided it's a very good deal and I work very, very hard. But if everybody wants a 10x return on their money, well, you're not going to get it from being a passive investor. And I'll tell you that. So when I'm that blunt with people, they're like, well, all right, I don't have the time to do that right now. So the next 2 or 3 deals, I'll invest with you passively and I'll learn the business, they say. So once you establish that credibility and that integrity, and you can feel it when you speak with them, that's when you establish a connection. And then you want to start building on that connection with them. Like, I actually care about you as an individual investor. You told me you don't like an old 60s properties, and I'm not going to share this with you. I'm not going to try to talk you into an investment. It's got to be your decision because you know it fits. And I'm going to tell you, based on this criteria, this deal actually is not a good fit, because let's say you want a lot of cash flow and this is more of a value add. Well, the first 6 months, there's not much cash flow. The first 12 months, there's only 4 or 5%, not an actual 10%, right? So things like that. If you're authentic with them, they'll appreciate your honesty and they'll actually either invest with you or refer you to somebody else, right?
That's true. Mhm.
And so if you think of it transactional, like, oh my gosh, I'm wasting 20, 30 minutes of my time talking to the person and they're not even going to invest in my current deal and I'm desperate and I need somebody for this deal. If you go in with that mindset, you're going to lose them. But if you go in with a mindset of, oh my gosh, this person, I'm going to solve their problem. I'm already committed to these 30 minutes with them, whatever the call you book, and maybe something will come out of it only 2 years later. But if you're very transactional, like I've got a deal for which I've got to close in 2 weeks and I need money now, you go in with that attitude, you're going to lose them. So
that's true. You said it very well. So one question I'm going to ask you about the deal is, right, when we are underwriting the deal, we don't know which way deal is going to go, right, initially. So, but we kind of know the deal can go south or deal can do very well. So what kind of measures you keep in mind once you're just underwriting the deal or once you write your business plan that, so the deal performs, it does not go south, or you do not have to do the capital call? What kind of measures you put in place?
So a huge part of why I choose my deals very carefully, etc., is from the mentoring I got. And my mentor is Brad Sumrock, and his program also has coaches in it. So before I make an offer on a deal, I already have a couple of coaches looking at my deal and telling me it makes sense or it doesn't make sense. Because you know what? When you're chasing a deal and you want a deal, you're going to want to make the numbers work, right? You don't want to do that. So one of the basic things you want to do is, first of all, how realistic is every number that you put into that spreadsheet? That's what you want to justify. Doesn't matter what that number is. Did you get a quote from a lender, or are you imagining getting 80% LTV, right? So what's more realistic? Maybe only 75%, right? So do you have an actual term sheet that says that? When you put all those rent bump numbers, right? Who justified that? Do you have a property management company locally managing a property in that 1 mile radius, 5 mile radius, giving you those numbers and saying, yes, Sandhya, those numbers are realistic for rent bumps? What about your other income sources? Oh, I'm going to, I don't know, get $10,000 in reserved parking. Well, did you drive around the property? Does it make sense to pay for reserved parking there? Or is there ample parking spot? How are the comp properties nearby, the 5 other properties within a 1 mile radius? Do they also pay that kind of money for reserved parking, right? So really, you got to thoroughly understand your little submarket and have every number in your spreadsheets justified, because then you know those numbers are validated by somebody besides you, because you may want to tweak the numbers a certain way. Another basic assumption is, what is the purchase cap rate for your property? A stabilized cap rate, like once you take over, it's about 6 to 12 months of operations, you've got it to a number. And then what is your exit cap rate assumption? So I always assume that the market is going to be worse in 4 or 5 years when I'm going to sell a property. So my exit cap rate or reversion cap rate is going to be at least 1 point higher, 100 basis points higher. So if I'm buying it at a 4 cap, at least a 5 cap at the time of sale. So if you change even that one number to the same or lower cap rate, that's a far more aggressive underwriting, and you're going to have humongously great looking numbers. So if you're just a passive investor looking at 2 deals and saying, hey, this deal is going to get me 120% return in 5 years, this deal is only giving me 80% return in 5 years, well, is it an apples to apples comparison? So that's where you ask this question about the cap rate assumption, the leverage on the loan, the interest rate. If it's a fixed interest rate, that they factor in the prepayment penalty for selling it in 3 or 4 years. There's so many little nuances in there that if you don't have a third party verifying numbers for you, like in Texas, you've got to account for taxes. Dallas County is going to go crazy aggressive after taxes because they're behind. Their numbers look terrible. Dallas County is suffering, so they're going to come after you for taxes. So did you underwrite it with another tax protest company telling you this is what you expect to pay in taxes for this deal, right? And that number is in there. Insurance, right? What if you have 20 buildings and one building is in a floodplain? How does your lender look at that? How does your insurance company underwrite that, right? And until you have those numbers, you don't really know what your insurance cost is going to be. And just taxes and insurance are 2 numbers that can completely throw off a deal. So to really underwrite a deal from an operator perspective, you want to have neutral second or third pair of eyes looking at the deal. Because if the only people looking at the deal is your little sponsorship team, you're going to want to make the deal work badly just to say you got a deal. I know the mentality. I know how it feels. I've had a few deals under my belt. I still feel like, oh, I wish that I could make this deal work. It's such a fantastic location. It's such a beautiful property. Get neutral eyes to verify every number on your spreadsheet and you'll be fine.
I think you said it very well. Collaboratively, you can do better and achieve more and make the
Mhm.
strategic decisions. And the second thing you mentioned earlier is the communication. Because once you close the deal, it's not mean that you're done, it's over. That's where the fun starts. So you gotta be, on point on all the communication and everything. So remind me, where you are in your real estate career now, how much assets that you have under management.
So if we close this deal in March, we'll be crossing 100 million in assets under management.
Congratulations.
Thank
Nice.
you. I've had a full cycle that was extremely successful, that in 27 months, we were able to return a 3x to passive investors. And of course, past performance is not indicative of future.
Sure.
I want to always say that, but it was a combination of really good cap rate compression, for which I have to give credit, but also very good asset management, right? To execute the business plan through 2 years of COVID. So both of them contributed to that, while, in the same time period, literally fall 2019 to fall 2021, my worst performing deal just barely returned my principal to me. So, and my deal was only 86 doors. This worst deal was over 1,200 doors. But look at that, right? So it's all about, are you focusing on the right things in asset managing your property, which is delinquencies, right? How are you addressing delinquencies today? Is a question I would ask any operator. Texas rent relief is over. Can your renters afford to pay your maximum rent? What is their income? So you should do a lease audit. You should check for their annual income to see if it can be at least 3x your max rent for the year for that particular property. So just checks and balances in place, is very much necessary. And I don't know if I answered your question.
Yeah,
fully,
you did.
but yeah.
Yeah, I think you put it very well, because the thing is, everybody, you need to have some mentor to learn all these skills, because this is not going to happen overnight, just like that. Oh, I got a deal, I know everything automatically or by reading the books. Because if somebody's there to guide you, that's the best thing that you have. That's a blessing, I would say. So, I'm sorry, we are kind of running out of time, and you have so much knowledge to share with me. Sandhya, I love that. But I wanted to ask you this question now. Where do you see yourself 5 years or 10 years from now?
I see myself doing 2 large deals a year to the tune of at least $50 million each, so that I'm not doing a dozen $10 million deals, as an example.
That's good. I'm so happy for you. So share one golden nugget with my audience. Not that you didn't share enough, but one special golden nugget.
Persistence. There is always a way. If one path that somebody else did doesn't work for you, find another path, because there is another way to get there.
That's true. There's so many doors. If one is not opening, find another one. That's a good one.
Yeah.
So this brings us to our rapid fire round. I'm going to ask you 5 questions. You have to answer me in 1 word or 1 sentence only. Are you ready? All right. So who was the most influential person in your life?
Tony Robbins.
What is the best book you have read or recommend?
I like the 12-week year.
Nice. That's a good one. What is your biggest passion?
Travel.
In 1 word, what does life mean to you?
Fulfillment.
I love that. What is your favorite food?
Tex-Mex.
Oh, how can people reach out to you?
Multifamily4u.com. Multifamily number 4you.com is my website. They can send me a message from there. I'm also available on LinkedIn and Facebook.
Thank you, Sandhya. I really enjoyed my time with you here.
Thank you so much for having me. You're an awesome host.
Thank you.